In 1910, 9 men met on a private island and shaped the financial architecture that would control the American economy for over a century. That island was Jekyll Island, off the coast of Georgia. The year was November 1910. The meeting itself was kept so secret that participants signed agreements never to publicly acknowledge it happened together. According to historical records documented by journalist B.C. Forbes and later verified in the memoirs of Federal Reserve architect Paul Warburg, this gathering represented the most consequential financial negotiation in American history. Here is what changed everything: the men who attended were not government officials. They were private bankers. J.P. Morgan, Rockefeller representatives from the National City Bank, and leading Wall Street financiers gathered with a single objective: to design a private banking system that would serve the interests of the banking industry itself, not the public. They drafted what would become the Federal Reserve Act of 1913. This is the critical fact. A central bank, presented to Congress and the American people as a neutral guardian of monetary stability, was actually constructed in secret by the very financial institutions it was designed to regulate. The Federal Reserve was not a government agency protecting citizens. It was an industry consortium protecting itself. Now zoom out and see how this mechanism actually operates. The Federal Reserve sets interest rates that affect lending, inflation, and employment across the entire economy. Yet the Federal Reserve is privately owned by its member banks. These banks profit directly from Fed policy. When interest rates rise, bank profits rise. When the Fed purchases assets, those assets are often held by the same institutions that designed the system. According to economist John Kenneth Galbraith and documented in congressional records, this arrangement creates a structural conflict of interest at the heart of American finance. The institutions being regulated are simultaneously the institutions that benefit from regulation. Today, this system has evolved. BlackRock, Vanguard, and State Street now hold combined voting power in most major American corporations, including the banks themselves. The Federal Reserve still operates with a board of governors who maintain the appearance of public service while defending policies that disproportionately benefit the financial sector. When inflation surged in 2022, the Fed raised rates aggressively, which benefited banks and investors holding bonds, while pricing millions of ordinary Americans out of home ownership. The pattern established on Jekyll Island persists, private financial interests shaping the rules that govern their own industry. As the banking historian Charles Geist wrote, the greatest trick the financial system ever pulled was convincing the public that it served them. The Federal Reserve is not a shadowy conspiracy. It is something far more elegant and far more troubling, a legal arrangement where the regulated write the rules of their own regulation.